Hi everyone, welcome to my YouTube channel Learn Commerce with Namita. I am Namita Mane. In today's video, we are going to solve an example of income from house property. This is example number 2. In my last lecture, I have explained you the introduction part of income from house property, the format, how to calculate gross annual value, then one solved example. Now in today's video we are going to solve the example of previous year university examination question. So this is the example. This example was asked in April 2019 university examination for total 8 marks. So the question is, Vasant Rao owned 2 houses for the financial year 2018-2019. The particulars regarding to the house property are as per below. So these are particulars and 2 houses are given. So particulars for house number 1, annual rent is given 3,38,000. For house number 2, 2,35,000. Fair rent 3,35,000 and 2,32,000 for house number 2. Municipal valuation is given for house number 1, that is 3,36,000. Then 2,35,000 is for house number 2. Municipal tax paid for house number 1 is 4 lakh, which is paid, in bracket it is written, and for house number 2 5,000 is due. Then land revenue paid, ground rent due, interest on loan borrowed for construction of house. So house number 1, interest on loan borrowed for construction of house is not given, and house number 2, interest on loan borrowed for construction for house number 2 is 1,14,000. Now what is the nature of occupation? That house number 1 is let out for residence. Let out means it is given for other person on rent, and house number 2 is let out for business. So this is also let out property. Okay, so both the house are given on rent to other person, and the owner is earning some income from this houses, house number 1 and house number 2. Let out for residence and let out for business. This word is very important, whether it is self-occupied house property, deemed to be let out house property, or let out house property. So if it is self-occupied house property, then the income from house property calculation will be different. Then deemed to be let out house property, the format of income from house property will be different, and for let out is different. So both the houses are let out. For first house is for residence and second house is for business. Now date of completion of construction is given May 2010 and April 2012. Okay, now what you have to calculate? So in the next line it is given that you are required to compute the income. You are required to compute the income from house property for the assessment year 2019-2020. So we have to compute the total income from house property for Vasant Rao for the assessment year 2019 and 2020 for both the houses, house 1 and house 2. Now how to solve or how to compute the income from house property? So let's solve. Now first of all you have to prepare this format. Okay, computation of taxable income from house property of Mr. Vasant Rao for the assessment year 2019-2020. Now we have to compute the taxable income of house property for house number 1 and house number 2. So in particulars you have to follow these steps. Okay, and for house number 1 and house number 2, both the houses we have to compute the income from house property. So both write particulars, then let out house property house number 1 and let out house property number 2. Okay, Now first step is what? We have to find the reasonable expected rent or expected rent. Okay, now remember one thing. See, what is the step number 1? To find out the reasonable expected rent or expected rent. Now this expected rent or reasonable expected rent is computed on the basis of 3 factors. That is what? Municipal valuation, fair rent and standard rent. If these 3 factors are there, so we can find the expected rent. That is step number 1. Now what you have to identify in the question, that check whether standard rent is given or no. Okay, so here see, if where the standard rent is not applicable, where the standard rent is not applicable means if in question or if in example standard rent amount is not given, then what is your expected rent? Okay, so where the standard rent is not applicable, reasonable expected rent is municipal valuation or fair rent, whichever is higher. When we can consider reasonable expected rent as municipal valuation or fair rent, whichever amount is higher, we have to accept it as a reasonable accepted rent. Only when in the case of standard rent is not applicable. If the standard rent is applicable, okay, if the standard rent is given in the example, then reasonable expected rent is municipal valuation or fair rent, whichever is higher, but subject to maximum of standard rent. This point, okay, point number 2 means that we have to follow these steps. Okay, we have to follow this following steps. Clear? So now read the first question. Now if you see in this question, standard rent is not given. Okay, standard rent is not given, then expected rent will be what? If the standard rent is not given, then reasonable expected rent is municipal valuation or fair rent, whichever is higher. Okay, now first step is what? Find the maximum of the following. Okay, to find the expected rent, we have to identify from municipal corporation and from municipal valuation and from fair rent which amount is higher. Okay, so we have to take that as maximum amount. Now for house number 1, okay, for house number 1, municipal valuation is 3,36,000 and for house number 2 is 2,35,000. Municipal valuation for house number 1 is 3,36,000 and for house number 2 is 2,35,000. Okay, check the amount. Municipal valuation 3,36,000 and for house number 2 2,35,000. Next is what? Fair rent. Fair rent for house number 1 is 3,35,000 and fair rent for house number 2 is 2,32,000. So note down, fair rent 3,35,000 and for house number 2 fair rent is 32,000. Okay, now identify which amount is greater from municipal valuation and fair rent. So from house number 1, okay, let out house property number 1, municipal valuation is 3,36,000, fair rent is 3,35,000. So obviously municipal valuation is greater. So a maximum amount is 3,36,000. Now house number 2, municipal valuation is 2,35,000 and fair rent is 2,32,000. So municipal valuation of house number 2 is maximum amount. Okay, so maximum amount we got. Now next is what? In the step number 1 only, point number B is find the minimum of the following. That means what? We have to find this one, that reasonable expected rent is municipal valuation of fair rent, whichever is higher, but subject to maximum of standard rent. This sentence, okay, subject to maximum of standard rent, we have simplified in simple words, okay, like first find the maximum amount and then find the minimum from maximum amount and standard rent. Now maximum amount is what? Same, 3,36,000 for house property 1. For house 2, 2,35,000. Okay. Now next is what? Standard rent. Now is there any standard rent given in the question? No. That means for house number 1 and house number 2, standard rent is not applicable. Why? Because it is not given in the question. If it is given in the question, we would have taken the standard rent. Okay. Now see, read the this thing, first case where the standard rent is not applicable, then expected rent or reasonable rent will be what? Municipal valuation of fair rent, whichever is higher. So now here maximum amount, okay, so step number 1, we have to identify, we have to find expected rent. Okay, now standard rent is not there, okay, not applicable. So now maximum amount between municipal valuation and fair rent, okay, is what? Municipal valuation. So amount is 3,36,000 is the expected rent for house number 1. Now for house number 2, 2,35,000 is maximum amount. Why? Because maximum rent is same. Okay, now step number 1, that was reasonable expected rent, we have got reasonable expected rent, we have got. Okay, now next step is what? Step number 2. Step number 2 is find the rent received or rent receivable. So how to find the rent received and rent receivable? That is adjusted annual rent, means actual rent, adjusted actual rent means annual rent minus unrealized rent. Okay, now for house number 1, check in the question what is, how much is annual rent. So annual rent for house number 1 is 3,38,000 and for house number 2 annual rent is 2,35,000. So annual rent for house number 1 is 3,38,000 and for house number 2 annual rent is 2,35,000. Now check whether there are any unrealized rent, okay, in the question. Can you see any unrealized rent here? No. Okay, so there is no unrealized rent. There is no unrealized rent. Dash. Okay, so hence the rent receivable or rent received, step number 2 is how much? 3,38,000 for house number 1 and for house number 2 is 2,35,000. Okay, clear? This much is clear. Step number 1, step number 2. Now we will move to the next step, that is step number 3. Step number 3 is what? Compare step 1 and step 2, whichever is more or higher. That means we have to observe step number 1 and step number 2 and take the amount whichever is higher. Okay, so now step number 1, amount is 3,36,000 for house number 1 and For house number 2, that step number 1 amount is 2,35,000, and step number 2 amount for house number 1 is 3,38,000, and for house number 2 is 2,35,000. Now if you compare house number 1, step number 1 and step number 2, so step number 2, that is rent received is more than reasonable expected rent. Okay, so we have to take whichever is more or higher. Between whom? Between step 1 and step 2. So step 2, that is amount is 3,38,000 is more. Now in house number 2, both step 1 and step 2 is same, so take the same amount, that is 2,35,000. Clear? Now from step number 3, we have to less the loss due to vacancy. This loss due to vacancy is a step 4. Now check whether there are any losses due to vacancy in the question. Now can you find any losses mentioned in this question? No. Okay, so step number 4, that is less loss due to vacancy. So there are no losses due to vacancy, hence it is not applicable. Okay, now next is what? Gross annual value. Hence there is no loss due to vacancy, so our gross annual value for house number 1 is 3,38,000, and for house number 2, and gross annual value will be 2,35,000. Okay, so there is no losses. From step 3 means from step 3 we have to less step 4, but in step 4 there is no amount, there is no losses, hence directly gross annual value is 3,38,000 for house number 1, and for house number 2 2,35,000. Now from gross annual value we have to less the municipal tax paid by the owner. Okay, now municipal tax paid by the owner, if it is paid by the owner, then we have to deduct it from the gross annual value. If the municipal tax is paid by the tenant, then it is not applicable. We cannot deduct the amount from gross annual value. Why? Because as per the Income Tax Act, it says that municipal tax should be paid by the owner, and if it is paid by the owner, then only we can deduct the amount from gross annual value. Now check in the question, is there any municipal tax paid? Yes, it is given. So municipal tax paid for house number 1 4,000. Okay, and in bracket it is written paid. That means for house number 1 the municipal tax was paid. Now house number 2 municipal tax is 5,000, and in bracket it is written due. That means 5,000 is not paid. Now municipal tax, okay, it should be paid by the owner. So here paid is written. Okay, so for house number 1 the tax is paid. The amount of tax paid is how much? 4,000. Okay, so less 4,000. Okay, less 4,000. Now house number 2. House number 2 municipal tax paid is how much? 5,000. But in bracket it is written due. Due means it is not paid. Hence it is not paid, so we cannot deduct it from gross annual value. Okay, if it is unpaid, due municipal tax, then we cannot deduct it from gross annual value. That's why not applicable. Okay, for house number 2 municipal tax paid is not applicable. Why? Because it is due. Only house number 1 4,000 is paid, hence we will deduct it from gross annual value, and after we deduct it from gross annual value we will get net annual value. So 3,38,000 minus or less 4,000, we get 3,34,000. Okay, so for house number 1, net annual value is 3,34,000, and for house number 2, the net annual value is 2,35,000. Okay, why? Because municipal tax is not applicable. Now after this, once we get the net annual value, we have to less deduction. Okay, so deduction under section 24. First deduction is what? Standard deduction under section 24. Okay, deduction we have to make under section 24. So first deduction is standard deduction under section 24. So this standard deduction under section 24 says that 30% of net annual value. Okay, so for house property number 1, the net annual value is how much? 3,34,000. So 30% on net annual value for house number 1 is so 3,34,000 multiply by 30 divided by 100. So it is 1,200,000. Okay, so 10% on 3,34,000 is 1,200,000. Now for house, next will be 30% on 2,35,000. Okay, so for house property number 2, net annual value is 2,35,000. So find 30% on 2,35,000. So 30% on 2,35,000 is 70,500. So 70,500 70,500 is the 30% on net annual value. Clear? Now next deduction is interest on borrowed capital under section borrowed capital or loan. Now check here. See, interest on loan borrowed for construction of house is given. Okay, so interest on borrowed loan for construction of house. For house number 1 there is no interest, but for house number 2 the interest is given, that is 1,14,000. Okay, so now in case of see, remember one thing, in case of let out house or partly let out house, the house property maximum deduction, okay, in the case of interest on loan borrowed for construction, for renovation, okay, so will be what? 2 lakh rupees. So this is maximum, means it is below 2 lakh, so we can deduct it from the this thing, we can deduct it in standard deduction or in deduction under section 24. So interest on loan borrowed for construction of house. House number 1 there is no interest. Now for house number 2 the interest is given. So here for house number 1, not applicable, interest is not applicable. House number 2, interest is 1,14,000. Okay, 1,14,000. Now, so finally everything we have completed. Okay, from this question everything we have taken into the calculation part. Now from net asset value deduct the standard deduct the deduction under section 24. So 3 lakh for house property, we have to calculate the final income from let out house property number 1. So net annual value is 3,34,000 less 1,02,000. So the amount is 2,33,800. So for house property number 1, income from let out house property 1 is 2,33,800. Now for house number 2, net annual value is 2,35,000 less 70,500 less 1,14,000. So 50,500 is the income from let out house property number 2. Clear? So for house property number 1, income from house property is 2,33,800, and from house property 2, income from house property number 2 is 50,500. So total taxable income from house property is equals to, property 1 is how much? 2,33,800 plus 50,500 is equals to 2,84,300. Okay. So this is the total taxable income of Mr. Vasant Rao. Okay, so total taxable income from house property number 1 and 2, that is 2,84,300. Okay, in this way you have to compute the taxable income for house property. Even if there are two property 1 and property 2, simultaneously you have to write down the values in the particular format. Okay, so I hope you have understood this example. Remember one thing, this example was asked for 8 marks in SPPU examination April 2019. Okay, so this is also important. This is like a revision for you while preparing your upcoming examination. Thank you very much. Please subscribe my YouTube channel, like and share the video, and do not forget to press the bell icon to get the latest notification.